It's time for Yahoo Finance's Market Minute. Stocks falling, paring back earlier gains to kick off the month of March. Intel shares higher on reports of two new potential customers for the chip maker. Reuters reporting that Nvidia and Broadcom are running tests on Intel's latest manufacturing process. Intel gaining these chip designers as customers would be a huge win for the company's struggling foundry business. And crypto-related stocks like Coinbase, Robinhood, and MicroStrategy are rising today after President Trump announced a strategic crypto reserve that would hold Bitcoin, Ether, and other tokens. And shares of Chipotle are higher after Morgan Stanley upgraded the stock to overweight from equal weight. The analyst saying an entry point has opened up for buyers amid choppy demand and some structural issues. And that's your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan the QR code below to track the best and worst performing stocks of the session. Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and the tricks that you need to grow your money. Hey, on today's show, President Trump announced a strategic crypto reserve. We'll discuss what this means for investors in the space. And the state of student loan forgiveness has changed under the new administration. I'll talk to an expert about what borrowers on the save and income-driven plans need to know. Plus, AI is likely to change the way that we work as we know it, and an economist will share the key ways to upskill for the future workplace later on in the hour. You don't want to miss it. We've got all that and much more coming up, but first, we take a look at some of the market action. We are 90 minutes into the trading activity, and stocks wavering to kick off the first trading day of March. We were higher, now we're lower. Joining me now, we've got Veronica Willis, who is the Wells Fargo Investment Institute Global Investment Strategist. Great to have you here with us, Veronica. You are viewing the current volatility as an opportunity to reposition. And we've kind of heard this from a few strategists and portfolio managers talking about this as the great repositioning or the great rotation, if you will. Walk us through how you're doing that.
Yeah, absolutely. So we've gotten a bit of a rocky start to the year. And with this pullback that we've seen in equities, it's a great opportunity for investors to have that chance to add to equities again. All through the past couple of years, we've just seen those equities march higher, and there hasn't necessarily been a great buying opportunity for investors. So anyone who's been having cash on the sidelines, now is just a really great opportunity to get some better valuations, get a better entry point to add to their equity positions.
Where do you think the sectors that are inducing or at least attracting most of that rotation are right now?
Yeah, I think right now, with that pullback that we've seen in tech, we've seen some of those other sectors starting to benefit a little more. So financials has certainly done really well. We also like industrials right now. We like energy, and we like communication services. So, pulling a little bit from that tech, but not too much, and adding to some of those other sectors.
Veronica, the theme of the week, it seems, if this gets enacted, is the tariff man cometh, and all those things that we've been continuing to watch from campaign now to action. It ultimately raises the question of what type of impact we're anticipating for volatility tied to tariffs.
Yeah, I think we've seen a lot of market volatility tied to, the risk of tariffs. If those tariffs do get implemented tomorrow, it could contribute to a little bit more market volatility. But I do think the market has, priced in that possibility of additional tariffs already. The market's also starting to price in the possibility that inflation will be a little stickier, maybe a little bit more elevated with the implemented tariffs.
And so if we are to see that take place and inflation be a little stickier, what does that hold for the Fed, and what's the trade-off of that? Because now we're talking about potential impact to one of their dual mandates, and then additionally, we've already seen the consumer mindset say that there is a little bit more pessimism into the system with regard to business or employment opportunities right now.
Yeah, that's exactly right. So if that inflation remains a little bit more elevated, we're not likely to see the Fed cut a ton of times this year. Our base case is that the Fed is going to be able to cut rates once more this year, but that risk that they may just be on pause for a little bit longer than we're expecting is rising the more that we see that inflation number stay elevated and that weakness and that uncertainty developing in the labor market.
So let's talk about that a little bit more. Your expectations from this week's slate of employment situation data, which ultimately will come to a head with the U.S. jobs report later on this week on Friday.
Yeah, so we're thinking that the labor market is holding steady here, maybe not necessarily as strong as it's been in the past couple of years, but we haven't really started to see signs yet of any broad deterioration. If we do see that, that's going to be a bit of a shock to the market, especially with those expectations for what the Fed may do.
And so from the areas of the market that you're anticipating the most perhaps impact, especially on the employment side, we've of course been continuing to track the changes that the Department of Government Efficiency has been making in those cuts that have come forward. Do you expect that to actually roll through to this print? And what type of broader impact do you think that holds?
It may be too early to see those impacts in this print. We might see some early impacts to it. And I think in the coming months, that's when we'll really start to see those impacts filtering through in the employment numbers, especially in that monthly jobs report.
Veronica, thanks so much for taking the time here with us today. Really appreciate it. Good to see you.
Thank you.
Bitcoin is rebounding today, back up over $90,000 after President Donald Trump announced the creation of a strategic crypto reserve that will include Bitcoin, Ether, XRP, Solana's SOL, and Cardano's ADA. Joining me now on this, we've got market domination co-host Josh Lipton. You've been all across this one, Josh.
So, Brad, it is welcome news for crypto fans. President Trump once again talking about his plan for a U.S. strategic reserve of cryptocurrencies, including, he now says, Bitcoin, Ether, and 3 other tokens. A U.S. crypto reserve will elevate this critical industry after years of corrupt attacks by the Biden administration. Trump saying on Truth Social, "I will make sure the U.S. is the crypto capital of the world." Trump campaigned, of course, as a crypto ally and won over the industry with bold pledges, including this idea of a strategic crypto reserve. As our colleague David Hollerith does report out, it's still not clear how exactly this would work, but Trump can order the U.S. government not to sell a stash of roughly tens of billions of dollars worth of Bitcoin it has acquired through criminal seizures and other forfeitures if they are unclaimed. The government has acquired other crypto assets in a similar manner, though no one is quite sure how much in total it does hold. Congress would likely need to step in for further steps like what Senator Cynthia Lummis proposes, having the government actually buy more Bitcoin. Bitcoin did surge nearly 60% over the 6 weeks following Trump's win in November, eventually hit a record of more than 109,000 on January 20th, but the euphoria then faded and the slide started. Bitcoin is still off nearly 20% from that all-time high, though up around 15% from last week's low. The sell-off was due to different factors, broad macro uncertainty causing investors to avoid assets thought of as more risky, and that recent news of a $1.5 billion hack of crypto exchange Bybit. Still, Bitcoin bulls have been quick to argue on Yahoo Finance that there are continued reasons for optimism.
If you go back and you look at the 2017 bull market or the 2021 bull market, historically we see anywhere between 4 to 7 drawdowns of 30% or more. And so really what we're seeing is just what has always happened. Bitcoin is a volatile asset. That's what people are buying. It's buying volatility. So if you want Bitcoin to go up, you've got to be okay with it going down sometimes. And these kind of cooling off periods or these consolidations are very natural.
Now, analysts at Bernstein also recently weighing in, telling their clients that they see Bitcoin as possibly dropping as low as 70,000, but they emphasize that nothing fundamental has broken in their structural view of the current Bitcoin cycle. Bitcoin is yet to claim a cycle high, which we believe is closer to the 200,000 mark over the next 12 months, they said. And by the way, the Journal reports that Trump is expected to host and speak at the first ever White House Crypto Summit on Friday, so stay tuned for more possible headlines. Brad.
Josh, thanks so much.
You
We'll
got it.
be tracking this very closely. We know you will be too. Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Today, we're focused on some big retail names reporting results this week. And for that, I'm joined by our very own Brooke DePalma. Brooke, Great to have you here with us to break these down. First up, we got to talk a little Target, as it's called out there. Target shares slightly higher on the day here as we're taking a look at the move higher of about 0.9%. Company had a rocky 2024. Shares ended the year lower by about 5% as it lost market share to Walmart. So what can investors expect here?
If Target has to continue to battle against this idea that consumers are flocking to Walmart for grocery and they're still pulling away from discretionary purchases. Now, as far as what exactly Wall Street's expecting here, they are expecting revenue to come in at $30.67 billion alongside adjusted earnings per share of $2.26. And get this, a slight increase in same-store sales growth of 1.18% there. Now, investors really have an eye on that continuation of an update that we heard earlier this year of a strong holiday in November and December. During those 2 months, the company said that it saw a same-store sales growth of 2% as well as traffic growth of nearly 3%. In addition to that, we know that cold weather in January could have helped pull inventory forward, but investors really keeping an eye on that 2025 outlook. Will this be the year that Target is able to regain that discretionary general merchandise same-store sales increase? Now, we know that the offset of that could be consumers doubling down on promotional items. Now, that could hurt same-store sales growth within general merchandise. We know that Target is really trying to push newness. They have that new partnership with Champion. They're also trying to push value. We know that under their wellness category, they're pushing for under $10 price points. Investors also keeping an eye out for alternative profit streams like that media business, Roundel, which competes with Walmart Connect's advertising business, and that membership model, Target Circle 360. We continue to watch out for something like that. Could that bring in new members to Target?
All right, they got some of my dollars. We also covered the big social media push for an economic blackout on Friday. Target was definitely on the list of places that people were avoiding. What can you tell us there in terms of what we're anticipating the company might say about that?
Yeah, well, keep in mind, tomorrow is not just fourth quarter results for Target. It's also Target's Investor Day. And they're expected to get questions about what exactly that February 28th boycott meant for the company. We know that results won't show in the fourth quarter because February 28th is part of the first quarter results. But this economic blackout that they called this boycott on Friday initially was intended to combat what one founder of a company, or rather an organization, called price gouging. He accused the company of price gouging. That was his initial idea, but it really got combined with that pushback to DEI because Target had pulled out of their DEI efforts. And so this is expected to be a top conversation with the Investor Day tomorrow, but we won't know exactly what this past Friday meant with that boycott and how it hit same-store sales, foot traffic, etc., till the first quarter.
We're going to be continuing to watch Target, another big retailer in focus this week. Best Buy. Shares edging lower here today by about 0.75%. Stock has had a tepid year in 2024, just single-digit move higher. And so we've got a lot of expectations for this one, knowing the pullback in some of the larger consumer electronics and appliances as well.
Yeah, exactly. That pullback is expected to be an ongoing story for Best Buy as well. We know that revenue is expected to come in at $13.69 billion alongside adjusted earnings of $2.39. But for fourth quarter, we are still expected to see that negative same-store sales growth of roughly 1.5%. Now, three things to watch for in Best Buy is this ongoing weakness around discretionary goods. Now, that's expected to be driven lower by ongoing weakness in appliances, entertainment, consumer electronics. So many investors keeping an eye on that 2025 guidance here as well. They do expect the guidance to be about 1.33%, a single-digit increase there, as this replacement cycle has Wall Street excited here. They're thinking, okay, will consumers get more laptops, more notebooks, especially as we come 4 to 5 years out from the COVID-19 pandemic. They're calling that 4 to 5 year range from Q1 2020 a sweet spot here. And also, we're really watching out for this potential tariff impact. I mean, what timing here for Best Buy's earnings? That tariff potentially going into effect tomorrow, March 4th. Also, Best Buy coming out the results. We know that in the past, Best Buy has said that price increase, that impact of tariffs will have to trickle down to the consumer. Roughly 60% of Best Buy products come from China. Mexico is their second largest supplier. And so this could take a big toll on Best Buy. We know that. We'll expect to hear from executives on how exactly they plan to offset that. will that mean a price increase for consumers?
Yeah, the replenishment rate is low on my TVs right now. So well capitalized there. Thanks so much, Brooke. Appreciate it. Coming up, everyone, changes for student loan borrowers. We're breaking down what you need to know next on Wealth. Millions are getting ready to head out of town for spring break, just a few weeks away. While costs have gone up this year, there are still some ways to maximize those savings. Here with the details, we've got Yahoo Finance's Carrie Hannon. Carrie, first and foremost, where are you going and how can we maximize the savings?
Brad, yeah, I don't know about you, but I am ready to go. Definitely ready to go. It's been a cold winter. Here's the deal. Travel demand, as you said, is up. Prices are up as well, both for airfares and for hotel rooms and so forth. But Americans don't seem to care. They're like, okay, we're going, we're ready to go, and we're going to spend more. We realize we're going to spend more this year. And so, but, there really are ways to get around it. And it's not, it's not rocket science here, but you need to be flexible, right? If you can, for whatever reason, not leave on a Friday, a Saturday, or Sunday, if you can travel midweek, you're going to find the best deals. And that's pretty hard to do when you have a school vacation or something like that. But if you have some flexibility, the other good thing to do is, one of the experts I talked to said, follow the deals, not the destination. So think of a couple places you might want to go. And then set those price trackers. Most of the apps like Hopper has one, and Kayak has one, and Google Flights. Set those little trackers. So when something dips and you're like, hey, let's do that. That's a good price for me. So you really want to try to look at some of these ways. But what the experts I talked to last week said to me was that people are really heading overseas. International is big, whether it's Portugal or Spain or going to Rome, Morocco. These are spots that are in demand. And yes, of course, people want to go to Florida for spring break, right? That's a classic. So we're seeing the uptick, and it's just, if you think you're going to go away for spring break, get on it, pedal to the metal here.
Absolutely. Carrie, thanks so much. I'm going to be watching this. Since President Trump won the election in November, there have been several changes for student loan borrowers. Just days before leaving office, President Biden issued his final round of student loan forgiveness, saying the former president approved a total of $189 billion in forgiveness for over 5 million borrowers. However, Biden's Saving for a Valuable Education, or SAVE plan, is facing legal setbacks. On February 18th, an Eighth Circuit Court decision ended both the Save and the Repay programs. It also blocked 25-year forgiveness in the Income Contingent Repayment Plan, or ICR plan. That leaves the 8 million borrowers who signed up for the Save plan in interest-free forbearance. Days after the court decision, the Trump administration removed access to the online application for both the Save plan and the income-based repayment plans, writing, quote, a federal court issued an injunction preventing the U.S. Department of Education from implementing SAVE and parts of other income-driven repayment plans. As a result, online loan consolidation applications are temporarily unavailable. Here with more, we've got Mark Kantrowitz, who is the student loan expert and author of How to Appeal for More College Financial Aid. Mark, where does this latest action leave borrowers?
Well, it should be a temporary suspension of the applications for income-driven repayment plans and loan consolidation. The U.S. Department of Education has told the loan servicers that they should stop accepting and processing these forms for the next 90 days. And that's actually similar to something that happened during the Biden administration when they had a similar issue with having to change the forms that are used to accept choices of income-driven repayment plans. So,
Mark, we're going to try.
It should take them a few months to remove SAVE plans from this.
Mark, do you have us?
Yes, I hear you.
Okay, all right. Sorry, you were breaking up there for a quick moment. Just to let you finish your answer to that question with this additive thought, what actions can students take or borrowers right now take?
Well, there's nothing that a borrower can take to get into an income-driven repayment plan if they're not already in it. If they're experiencing financial difficulty, they should look into the economic hardship deferment, unemployment deferment, and general forbearances. The only repayment plans available to them are standard 10-year repayment, graduated repayment, and extended repayment until the Trump administration restores the form.
And so, for people who are trying to figure out remedies or alternatives, are there other plans that student borrowers can sign up for?
Well, and there's standard 10-year repayment, extended repayment, and graduated repayment. Extended repayment will probably have the lowest monthly payment unless the borrower graduated very recently, in which case graduated repayment may be barely above interest only.
Understood. So what are some of the other actions on student loans that Republicans have talked about that we might see activated, and how borrowers and students who are even just preparing financially for college, how they can start to think about what might be coming down?
Well, the Republicans are going to need to balance out the tax cuts, the extension of the Tax Cuts and Jobs Act of 2017 and other new tax cuts with savings elsewhere. And they have a menu of items for budget reconciliation that include getting rid of the Grad Plus and Parent Plus loan, getting rid of the student loan interest deduction, eliminating the subsidized direct Stafford loan so that the borrowers will still be able to borrow the same amount. It will just be entirely unsubsidized. They previously got rid of it for graduate students in 2012. They may add risk sharing for student loan defaults so that the colleges will have to pay part of the amounts of the defaulted student loans. And there are a variety of tax credits for education, like the American Opportunity Tax Credit and the tax-free status of qualified scholarships that may go away.
So as we're thinking about all of these changes, there have also been rollbacks in terms of the number of people that are working and the workforce at some of the colleges and universities that have and get federal funding. In the face of some of the rollback of some of those funds, how does this impact those who are repaying to universities or currently going to some of those universities as well, if at all?
Well, the cuts in overhead for the NIH and NSF grants, which can be severe at some colleges, that may affect graduate students because the faculty researchers fund the graduate students out of those grants. So you may see some colleges halting enrollment of new graduate students or halting enrollment of new hiring of new postdoc. So that may make it more difficult for graduate and professional students to pursue an education. If you are working for the federal government and your employment was eliminated by DOGE, or you've been impacted and lost your job at a university, that can affect your ability to get public service loan forgiveness. You have to be working in a qualifying job while in one of these income-driven repayment plans. So it's important to get a new job in a qualifying job or multiple part-time jobs that are qualifying jobs so that you continue to qualify, your payments continue to qualify for income for the public service loan forgiveness. And qualifying positions include not just working for the federal government, but working for state, county, and local governments, working for the military, and working for a tax-exempt nonprofit organization like a 501c3 organization.
Mark, thanks so much for taking the time here with us today and really laying out some of these changes that have come forth. Appreciate it.
You're welcome.
Coming up, have you filed your taxes yet? If not, our next guest recommends you do so right away, and we'll tell you why next on Wealth. 2 hours into today's trading session, let's get a check of the markets right now. We're taking a look at the U.S. major averages right now, and the theme right now seems to be intraday searching for direction. Take a look at some of the bounce lower that we've seen, unfortunately, here as we're now at intraday session lows for the Dow Jones Industrial Average right now, down by about 0.25%. The NASDAQ Composite, let's take a look at that. Started off today in positive territory, but now has swiftly moved into negative territory, much of that in the red for the tape activity for the NASDAQ. And let's also check in on the S&P 500. That has had its own own kind of waffling activity in and out of gains and losses. But as of right now, you're seeing us still not quite at intraday session lows, but in the red as of right now, down by about 0.3%. One of the factors could be the volatility that we're seeing continue to play out right now. Take a look at the SIBO volatility index, the VIX as we know it, as that fear gauge index sits still above 20 here. Just to put some more context on this, over the past 5 days, we're not quite at the highs that we've seen over that period. That would have been last week at the tail end of the session, but ultimately still hovering above that and near that 20 range. That is still more outsized. Compare that to the broader 52-week where we've only had a few spikes that have really moved us well past that 20 marker, that 20 gauge here. But ultimately, that's exactly where we're sitting a couple times that we've ultimately breached that level. And as of right now, we're still sitting above 20, and we'll see how that continues to impact the minds of investors that want to see just what's taking place quickly within the sector activity as of right now. Taking a look at a relatively split picture, as split as you can get for 11 sectors here, but we do have 6 of them in positive territory, it seems right now, where real estate is leading the pack. That's up 0.9%. Bringing up the caboose, though, on this down day for the U.S. major averages, as of right now, intraday, energy is leading the decline. That's down by about 0.8%. And we'll ride out with a quick look at the NASDAQ 100, some deep red, lake red, if you will, on NVIDIA. That's down by about 4% here on the day. And that part of a larger pullback that we've seen even post earnings. I'll put this on a 5-day view, and that should give that earnings context into view as well here, as that was last Wednesday. All right, we'll continue to track all of this and much more, but switching gears here. According to the Internal Revenue Service, in 2024, taxpayers were split, with nearly half waiting until March to file their tax return. And if you're one of them, no worries. We've got an expert on deck to make sure that you don't miss out on a single cent of that refund. Joining us now, we've got Andy Phillips, who's the H&R Block Vice President of the Tax Institute. Andy, great to have you here with us. You highlighted 3 changes that taxpayers might not be aware of. So let's start with the 1099K income. What's changed there?
Hey, Brad, good to see you again. Thank you for having me back. So like we talked about back at the end of January, probably the biggest tax law change for this tax season is around the form 1099K. So this form is used for a few things, but people who are impacted are folks who are selling maybe goods or services through an online platform, like maybe an Etsy or something like that, or who maybe provide in-person services, but take payment through a third-party payment app like a Venmo or a PayPal. So the threshold to receive a form 1099K went down drastically from 2023 to 2024, from you had to have over $20,000 in transactions, or at least $20,000 in transactions, and over 200 transactions during the year. For 2024, went all the way down to $5,000, and you just have to have 1 transaction. So what that means for this year is a lot more people are getting Form 1099Ks, and a lot for the first time. So the questions are, as you can imagine, what is this? What do I do with it? Is the full amount taxable? You know, the tip there is often with 1099 forms, you find with tax forms, no, it shouldn't all be taxable. So you want to make sure you're taking advantage of any deductions you can take to offset that income. But that's definitely been a big early season driver for us. People having questions, understanding what it means to their taxes.
And so what about 1099 DA income? What are the changes there?
Yep, so that one's more on a look forward, but starting in 2025, those folks that invest in virtual currencies, think Bitcoin and other cryptocurrencies, a lot of times in the past, you may not have necessarily gotten a 1099. Some of those platforms did, but not all of them did. And so starting in 2025, meaning for your taxes next year, for those virtual currency transactions, they're going to be required to issue you a new form called 1099-DA. What's important to remember for both that DA and for the K is not only do you get that form, it also means the IRS gets a copy of that form, and in most cases, your state will as well. So they're going to know about it. And so sometimes people don't always understand that those crypto gains and losses need to be reported and can be taxable if you have a gain. So that'll be a big change going forward.
And for taxpayers with children, how has the child tax credit changed?
Yeah, so that child tax credit, is really just an inflation adjusted amount where the child tax credit is $2,000 per child but a portion of that is refundable. That's called the additional child tax credit. What that means is even if you don't owe taxes, you can get some amount of that $2,000 to create or increase your refund. So last year it was $1,600 that was refundable. For 2024, it was $1,700. So that isn't necessarily driving the questions, but I'll tell you, questions around family, questions around life changes, like, hey, I have a nephew living with me. We're seeing a lot of questions around education this year. Where that often comes up is you have a child going off to school for the first time. And so you don't know the rules yet. You need to understand, what does that mean? What credits may you be able to take, like the very valuable American Opportunity Credit? A couple other situations where we're seeing quite a few questions about education credits and other benefits is one, people that go to grad school. Because once you get out of your undergraduate degree and move to grad school, the rules are a little bit different. And then people that are adults going back to school and understanding what they may be able to claim.
Why do you recommend filing early? And we asked this question because there have been a lot of changes and prompted by the Department of Government Efficiency, where we know that there have been federal layoffs that have also taken place here that have impacted the IRS. Why do you recommend filing early this year?
We're in March, so you can still file earlier than April. But what I would focus on is a couple things. First, file as early as possible. If you're due a refund, your return's going to get processed more quickly the sooner you file, and you're going to get that refund distributed to you. Another thing to think about is when you submit your tax return to the IRS electronically, your Social Security number is then locked. No one else can then use your identity to file a tax return with IRS electronically. So it effectively locks out like an identity thief or a threat actor who has somehow gotten your information through, sadly, one of the breaches we continue to see in the news, large scale breaches across the country, across the world. A little bit on that, though, on those questions around what do these changes mean? What do these mean to filing taxes? One, the rules haven't changed. The rules have not changed. Whether you're due a refund or you owe taxes, unless you get an extension, taxes are still due April 15th. Obviously, the incentive is clear. If you're due a refund, we see the IRS continue to process returns, continue to issue refunds, and we expect that to continue. That said, if you're filing, make sure that you're doing everything you can to follow the happy path in the processing of your tax return. File electronically. Avoid any mistakes that may result in a human having to touch your tax return, because it's foreseeable if you don't follow the happy path, meaning a human has to intervene in the processing of your tax return and your tax refund, you may see a delay. Likewise, for those people that are due, that have a balance due, you still have to pay that. The laws are still in place. And so don't think that there's some magic way that you're going to get out of that. In fact, even if you request an extension of time to file past April 15th up until October, that's only an extension of time to file. It's not an extension of time to pay. So if you're one of those folks who's going to request an extension, that's okay. But make sure you calculate and make a payment of what you expect to owe to avoid any penalties and interest, which the IRS will begin to, kind of impose against your liability starting after the due date.
I have to hustle to my finish here, but just very quickly while we have you here, Andy, any last minute changes that you can make still before you file?
Yep. I'll hit three real quick for you. One, for folks who have a traditional IRA, you can still, up to the due date of your return, make a tax deductible contribution to your IRA. There are limits on that. You can contribute generally up to $7,000 per year, an extra $1,000 if you're 50 or over. That can be impacted by things like maybe your income level, whether you or your spouse are covered by an employer's plan as well, and your income. Second one, I'd say if you participate in what's called an HDHP or a high deductible health insurance plan, and you have a health savings account, you can still make a contribution up to the max amount, up to the due date. Again, you can deduct that and reduce your tax liability. You want to make sure you're counting any contributions you made during 2024 by you or your employer to make sure you don't exceed your contribution limit, but that's an option. One last one, at the state level, many states, if you're saving for your child or someone's, let's say your child's education using a 529 plan, a lot of states will allow you to make at the state level a tax deductible contribution to that HSA, again, up to the due date, reducing your state tax liability. I live in Kansas. We have that benefit. And here's what's really cool. You don't necessarily have to participate in a 529 plan offered by your state. I participate in one from another state based on the advice of financial advice, but I still get that tax deduction on my Kansas return.
Andy, great to have you here with us. Thanks so much. Appreciate it.
Thanks, Brad.
Coming up, AI transforming the workplace. We've got tips to help you improve those skills no matter what industry you work in. That's next on Wealth. AI proficiency is becoming a necessity in the workplace. According to a report from Udemy, demand for AI skills nearly quadrupled in 2024. That's up 291%. Joining me now, we've got Misha Fisher, who is the Udemy economist. Misha, great to have you here with us. This data highlights a growing need for AI literacy. So walk us through what this means for the evolving job market.
Thanks, Brad. It means a couple of things for the evolving job market. The two big narratives coming out of this report are, first, like you showed, in the last year, we've seen a near quadrupling in demand. That's really telling us that this is not a one-off flash in the pan result just from the release of ChatGPT. People are realizing that these are real productivity boosters. The second big report the second big takeaway that's coming out of it is that it's not just limited to the tech sector. That's where we started talking about this at first. But if you look just in the last quarter, government course consumption's up just about 10%. Transportation as a sector is up about 11%. Manufacturing is up 50%. And then in finance, we saw just in the last quarter a 75% increase quarter over quarter in demand for these things. And what that's telling us is that if you're working in these sectors, you have to be very intentional and think through your productivity that you individually deliver and also the productivity that your team delivers, and recognize that these are tools and skills that augment those things and make you more competitive and make your team more competitive.
You know, as we think to this shift and think about the productivity, I can't help but almost kind of relate it to the era where you were only as strong as the pivot tables that you were able to create in Excel or the macros that you were able to make sure were all interconnected. This seems kind of similar to that. So is it almost like you'll only be as valuable or as productive as some of the prompts that you're able to create with AI? And how can people go about making sure that the prompt knowledge that they have is also translatable to what an organization needs?
Well, you really covered the two most important parts of that. So the first is, yes, it absolutely maps to this early story that we saw around computers. It's easy for people to forget that knowledge workers as a class of workers have existed long before we had computers. Things were just done with typewriters. They were done with slide rules. Then in the 80s and 90s, we saw a real expansion of things like spreadsheets, which of course led to the pivot tables you alluded to. These were real productivity boosters. It wasn't until the late 2000s that we even saw the phone-based portion of work-based productivity come into play. And so if you are working in those things, what we saw when these technologies were introduced was an expansion of demand for knowledge workers because people were more efficient and able to produce more. But if you were not on top of that, you might not have seen the career trajectory that you would have expected before the introduction of those tools. So you do have to make sure you have those skills. And you also mentioned the very important word, translate that into the business need. Yes, that is a huge part of this. These tools are interesting and they're fun and you can play around with them on the weekend. But in the end, what a company needs is for you to be able to boost efficiency, boost productivity, make your products better, make your company stronger using these tools. And you really need both sides of that equation. You need the skill set and you need to be able to map them.
As AI skills become essential, what can job seekers and professionals do to stay competitive then?
So as a job seeker or as somebody who's currently in a area where they just want to make sure that they're protecting themselves from downside risk in their employment, we've seen a slew of layoffs across sectors. That is certainly something that I think is front and center of people's minds. It's a 5-step process. So really think through this. So the first is build that literacy. Really learn the fundamentals of what you need to know about the tools generally and also specifically about your industry-specific application. The second is actually put that into use. Apply it in your daily work. If your company doesn't pay for it, you can pay for most of these tools for a pretty nominal monthly fee, or of course, there are some free tools available as well. So get that practice. The third is this issue around signaling. If most university programs, if they had one, to run through an undergraduate degree takes 4 years. Grad school takes 1 to 3. The tools aren't even that old. So it really is about those third-party certifications that you can find available. And those certifications are very useful signals that you've learned something, that you've put the time into it. Knowing the skill itself is half the battle. The other half is making sure that employers know you've learned the skill, or that hiring committee knows you've learned the skill. So you have to do that as well. The fourth is recognize that this is not the only thing. You still have to be able to communicate, to persuade, to build trust. Those are all universal human things that are valuable across industries, across careers. You really want to make sure that you're developing those soft skills alongside the AI, and that you can apply a critical reasoning to the results. If you think about it, in most hiring situations, if you're looking for a job, the hiring review, certainly in tech and probably in other sectors as well, is probably not going to want you to fire up ChatGPT or some other competitor program in the middle of your interview. So you still have to be able to show that you can think. And then the final one is just stay engaged, right? This is a constantly evolving landscape. So you want to really develop the mindset of continuous learning.
Just very quickly, and I got to sprint to the finish here. What does this all mean for wages and the recalibration of the value payout and compensation?
Usually what technology does, and I have no reason to suspect that Gen AI tools are going to be any different, is it increases the variance. If you can use these things, you are more productive, you're more valuable, your wages will go up. If you don't stay on top of these tools, you will become less valuable to employers, and you shouldn't expect to see the same sorts of wage gains.
Misha, a lot to consider here with this conversation. Appreciate your time and breaking this down for us.
Thanks, Brad.
We've got much more wealth coming up after the break, everyone. A brief programming note, the money behind esports is ever growing, even more so for the young competitors. PlayVersus CEO John Chapman joined Ross Mack on Financial Freestyle to share the big financial opportunities in the sector and what it means for their careers too. Let's take a listen.
Some of our best players in the country, they can just start playing the game and streaming while they're playing. And if they've got an engaging personality that creates an audience following, that all of a sudden becomes a platform and an audience that they can monetize and, grow a small business off, and maybe even a substantial business off of it as they grow. And so one of the things that we try to do, and we're going to do more of it going forward, is making the kids who participate in our community aware of those opportunities. A little bit of a, what's a playbook on how you could get there, how you could, develop that streaming audience, and how could you ultimately monetize it.
For more Financial Freestyle, tune in every Monday, 12 p.m. Eastern Time, or on Yahoo Finance, or wherever you get your podcasts.